This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jonathan Farrow and Lisa Abramowitz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts. And always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. What a joy to see her in London. Sri Kochagovan joins us right now, senior research economist at Aberdeen. Sri, I'm absolutely fascinated by how the U.S. stands alone, how Jerome Powell yesterday stood alone with massive stimulus leading into massive real GDP. Does the United Kingdom, where Governor Bailey stands now, do they need stimulus to keep it going?
I think stimulus would probably not be a good idea at this point. Really, what we want to tackle is inflation. Now, the Bank of England have a very challenging backdrop. Growth outlook is weakening, but we still have very elevated inflation pressures. Now, inflation is past the peak. It has started to decelerate. However, energy costs are still quite elevated. The headline inflation is still very high. And also we have, even though those commodity price base effects will start to unwind over time, we still have very sticky core services and wage pressures in play. So stimulus right now would not be a good idea for the UK. Now, it's not restrictive fiscal background at the moment, but further stimulus would actually not be helpful for the Bank of England.
Here's a fun fact from the Bloomberg News story that Lucy White wrote for us. Ben Bernanke actually attended the Bank of England's meeting as an observer as part of his review into the UK Central Bank's forecasts and communications. And of course, this comes as Bailey has faced some criticism that they didn't move quickly enough to respond to inflation. Sri, can you compare and contrast the efficacy of communication at the BOE versus the Fed?
I think, as we mentioned earlier, there was a conversation about groupthink. There is a split within the Bank of England, and I think the communication has been quite clear from the various members. We've had the arguments for staying on hold, the arguments for perhaps an additional hike, and all of those are quite consistent actually with the data that we're seeing. But it seems that on the whole, we are witnessing a switch towards a focus on growth and the weaker activity data, and some greater faith in terms of inflation actually past the peak and decelerating from here. So we're also seeing so we have a signal from the split in the vote, and we also have that signal very, very clear in terms of, rates are going to be on hold for a meaningful period of time, even if, as we expect, the economy enters a recession, rates are going to remain quite elevated. And that's quite a burden for small companies in particular, who are much more sensitive to the rate cycle. They are facing a profit squeeze. There is a bit of an issue there in terms of future business investment. And so there are a number of challenges there, particularly for the smaller firms. So that's something that the Bank of England are going to have to really be wary of.
Yeah, credit availability for small firms always an issue, whether it's stateside or across the pond. Sri, when it comes to the stimulus versus austerity debate that Tom was referencing, how does the Bank of England's decision to keep rates on hold for a second straight meeting and warn about a possible recession, warn about the need to perhaps raise rates in the future if inflation reaccelerates, how does that restrain or limit the government's options when it comes to supporting the economy?
I think the government is also very aware, and we have heard from Rishi Sunak, the Prime Minister, we have heard that there is a focus on inflation, even within the government. Yes, they do have an election coming up, but they're worried about stimulus too soon and too much stimulus too soon. So I think they're going to pare back on any measures that are going to fuel inflation further. I think that's also a concern from them. Again, a very challenging decision for them, given that there is an election on the horizon.
Right. Sri, are all the gains in the United Kingdom focused on London? I mean, is it like, the dominance of Paris and France? Are all the economic gains, which, have been tangible here, have they been focused on the south of England?
Well, there has been a big debate for a number of years with regards to the regional disparities. And that was something that for a few years there have been some focus on what are the policies that can help level up the economic outlook. However, it has been quite challenging in order to do that with the pandemic, recovery from the pandemic. And I think the leveling up policies may be, they're on the horizon in the future, but right now, really, the focus is quite narrow. So that regional disparity, unfortunately, is still very much there.
Sri, thank you so much. Sri Kochagovardhan with us with Aberdeen. Joining us now on the other points in the wars of Washington, Gregory Valliere. He's Chief U.S. Policy Strategist at AGF Investments. Greg, I believe it is November. That's 12 months away from an election. Take the drama of October and our many wars and fold it into how things change 12 months before an election. How does your world change given the pending 1 year out election?
Well, good morning, Tom. There are so many unknowns. I'd say one big one is Benjamin Netanyahu. If you saw the extraordinary story in the New York Times on Monday talking about how Israel and Netanyahu were blindsided by Hamas. They got totally caught off guard. There's going to be recriminations. I think that has to be looked at very carefully. There's that, there's the Fed, and there's this continuing fight in the House between fairly moderate Republicans and the right wing. That fight is about to resume within days.
Right, but you've got a right-wing Speaker of the House now. Shouldn't that restore some order in the House?
One would think, Scarlett, wouldn't one? But I'm not quite sure about that. I think that even a handful, 4 or 5 House Republicans could block this next spending bill. And there are Republicans in the House who don't want to spend money on Ukraine, as you guys know. And there's some lukewarm attitudes toward Israel. But the big fight still is a budget. We have a budget deadline in about 2 weeks, and they're not close to being done.
Yeah, and so we're watching that November 17th deadline very carefully. I want to get your take also on what the economy means for the presidential election. Try as it might, the White House has been selling Bidenomics, but it's not doing very well when consumers are feeling pretty sour. What does the current Fed policy mean for the economy in 2024?
Well, I think there's maybe some relief among consumers that the Fed didn't raise rates, but I thought you and Tom a few minutes ago hit it perfectly talking about food prices. I mean, food prices are up, what did you guys say, 19%?
Cumulative, yeah.
Over 3 years.
Over 3 years. But that leaves an awful lot of people, maybe not us, but leaves an awful lot of people discouraged that this is not improving.
Yeah, what's important there, Scarlett, is the USDA. This is really good data from the U.S. Department of Agriculture. They say that for the have-nots of America, it's not third world, but 30% of their compensation is going to food.
Which
right
means
now,
30% of their compensation is not going to discretionary spending or anything else that usually supports the economy. Greg, I want to bring it back once again to Fed policy and the economy in 2024, because Jay Powell's term expires as Fed chair in early 2026. So whoever wins the 2024 election would get to pick the next Fed chair. What does that mean to you? And I bring this up because if Donald Trump wins the nomination, yes, he nominated Powell as Fed chair, but he also nominated Judy Shelton as a Fed governor.
Yeah, I think if Biden wins, obviously he'll try to keep Jerome Powell. If Trump wins, he will get rid of Powell as quickly as possible, and that will, I think, cause some anxiety for the markets. You know, one other quick point I would make about what we could see in the next year or so that maybe is outside of the box. I wrote a piece this morning on Robert F. Kennedy Jr. There's a new poll out overnight from Quinnipiac showing him at 22%. That I was surprised. I think a lot of people were surprised to see that. And I do think that he will take away from Joe Biden young people, independents, African Americans, environmentalists. Robert F. Kennedy Jr. is not going to be the next president, but he may determine who will be.
Greg Valliere, thank you so much with AGF Investments. We can rip up the script with a gentleman that worked in the macroeconomic section at the Fed Jonathan Pingle joins, of course, with UBS, their chief U.S. economist. John, I'm sorry, I got to go here. And Julia Coronado, ex-BNP Paribas Macro Trends, was way out in front in this. Are we completely misguessing the efficiency, the productivity, the technological advancement of America? Are we just flat out too pessimistic?
It's hard to know what the expectations are, right? There aren't that many people as in the weeds on productivity, on the immigration rebound as Julia. And, I'll give Julia a lot of props since we were at the board together a long time ago. But I would say two things, and Chair Powell touched on this yesterday. One is, we have been seeing a pretty impressive rebound in labor supply, and that's been both a combination of a significant improvement in net international migration coming out of the pandemic, in addition to, some groups like prime age women punching out new all-time highs in their labor force participation rates. And, we've certainly been writing about that, and Julia's done a good job as well. On the productivity stuff, though, we do have to remember that productivity was incredibly weak as we went through the pandemic and immediately coming out. So we did have a fair amount of catch up to do. And when we look at sort of the longer run trends, after today's data, just mathematically, you are going to be a little bit above the longer run trend. So it is good news. But you're actually really still not that far from what we were seeing pre-COVID. But I will say together, I think it's right. We're seeing nominal wage gains slow, and some of that is these supply side improvements and unit labor costs dropping. We were forecasting a 7/10 drop. That is the result of the slowness we saw in average hourly earnings combined with basically 5% GDP growth in the third quarter. So that's a good supply side story.
Tell me about core services. The chairman didn't talk about it much yesterday, but are we seeing a service sector disinflation to give confidence to an outright goods deflation?
We are. I mean, we've had some positive news on the core services over the last several months, but I would say we're sort of not out of the woods yet, right? I think that's one of the reasons Chair Powell yesterday, and Mike McKee did a great job with his, trying to pin the chair down on the objective versus subjective decision. But what we want to see is a little bit more slowing in the labor market in order to see more slowing in those components of inflation. Because if we look at the ECI, it does look like wage gains are still a little too brisk to be consistent with sustainable 2% inflation. So I do think the chair, and Mike was just saying this, they do need to get the labor market to slow here if they are going to achieve their mandate and restore price stability.
All right, this is clearly a big week for labor market data. You had ADP employment change, JOLTS, and of course, jobless claims this morning, unit labor costs, as well, and productivity. We know that the UAW has come to agreements with the automakers, but if you are a union organizer, and I'm thinking of the Actors Guild, for instance, that is still on strike, what is your takeaway from the flood of data that we've gotten on the labor market right now?
Well, the labor market's still tight, right? So, even, and I don't really think you need to look much beyond the unemployment rate at 3.8% to say, the nation's at full employment and markets are tight. And, you've got a point here where there might be some bargaining power for workers. The other interesting thing about a number of these strikes is there are a lot of non-wage issues at stake. You're talking about, the use of AI for the actors. You're talking about, the shift to electric vehicles amongst the UAW. And that's actually been sort of an interesting aspect where, a lot of these labor negotiations, it's not just about the wages, it's really also about sort of these changing industry dynamics that they want to protect their workers from.
So how does that show up in the data? How does that show up in the economy in what's measurable?
Well, we should definitely see the impact of the UAW strike tomorrow in tomorrow's data. The BLS released their strike report. Between the strikes, the big three, and Mack Trucks, that should be about a 30,000 job reduction in motor vehicle and parts assemblies employment. You'll see it in Table B and B1 of the employment situation release. So we should definitely see that weigh on the employment report tomorrow. But that'll rebound in the subsequent report. And I think the bigger picture is that you have put in place for some of these contracts, a return to things like cost of living adjustments, et cetera. So this should generally mean for these workers somewhat firmer wage gains over the next few years than would have otherwise been the case.
Jonathan Pingle, thank you for the brief, particularly there quickly on advancing productivity. He is with UBS. I love saying this, the Union Bank of Switzerland. We're going to get complicated here and straighten this out. Hulu being taken out by Disney, Brian Roberts and Comcast unloading the dog. Geetha Ranganathan of Bloomberg Intelligence is truly encyclopedic on this near $9 billion transaction. Geetha, I'm lost here. Is Comcast happy today that they unloaded this stock, or is this a deal of a lifetime for Mr. Iger?
So this is, as you just pointed out, Tom, this is a pretty complicated transaction. All that we got yesterday was that Disney is definitely buying out Comcast's 33% stake. So Disney already owns 2/3 of Hulu. So we know for certain that Comcast is offloading it. Disney is buying it. Now, the biggest question here is going to be price. So we know the floor value was set at $27 billion. Disney actually came out yesterday saying that they do expect to make that initial payment of, it's actually $9 billion minus some capital calls, which is why you get the $8.6 billion.
Right.
But really, the point is going to be how much greater than $27 billion is the valuation going to be, and that is where all of the complexity is going to arise over the next few months.
I mean, John Farrow's addicted to Hulu. He's just, he like binge watches Love Island USA and the rest of it. Geetha, does it matter who watches this stuff in this transaction, or is this just people distant from what we watch every day?
I mean, Hulu has 48 million subscribers, Tom, so it is a very, very successful streaming service. You're absolutely right. It has a very deep catalog of classics. It has
like
also
Love Island USA. Geetha, you're not going to sell Surveillance's audience that Love Island USA is a classic. Continue.
Well, it has a lot of the must-watch shows, right? You brought up The Bear. Only Murders in the Building is a great show. It has a lot of shows that come up from broadcast TV, so it's a great catch-up service. And it also has kind of this live Hulu plus live option as well. So there are a lot of different flavors that it offers. But I think the biggest thing for Disney is really the ad component of it. If there is any streaming service out there that has got advertising right, it is Hulu. We know that Netflix is struggling with that right now. So is Disney Plus. So are a lot of the established services. Amazon is looking to bring an advertising service. Hulu is the one established brand already bringing in about $3.5 billion in ad revenue. So that infrastructure is a gold mine and is super valuable to Disney.
And for that reason, Hulu is one of the few profitable streamers. Netflix, of course, another profitable streamer here. But what is it about the ad packaging that Hulu has figured out? As a consumer of Hulu, it's really frustrating to see the same Tom Brady Hertz commercial over and over again.
No, you're absolutely right. But at the same time, I mean, this is a company, obviously they are the ones that have ads, that have had ads on now for the longest period of time. They've built they've built a very, very robust ad stack. And they've also kind of made all these different, relationships with advertisers. Of course, you have the larger Disney brand as well at work there. But that is something where they've really been able to crack the code. I mean, Hulu is one service where you have majority of, the consumers on the ad-supported option, which is what has made it such, so successful in what it set out to do.
Disney says it has enough cash and credit to buy Hulu, whereas Comcast will be using the proceeds to accelerate its stock repurchase program. When this financial transaction is completed, does it move the needle at all for either Disney or Comcast stock?
I think it definitely moves the needle for Disney because this removes a key overhang. Remember, there are so many strategic questions that are still kind of pending for Bob Iger, whether it's the future of ESPN, whether it's the sale of the ABC network. And so, kind of just closing this deal with Hulu and then integrating it with Disney Plus, I think just removes a key overhang for the stock.
5 years out, do they mate? Do you see Hulu combined with Disney Plus to really take on Netflix as a combined adult and kids entity?
Absolutely. I think that is what the plan is. I mean, at the end of the day, they are looking to get synergies across the board in their streaming product because Disney Plus is still losing money. It is still going to lose about $2.5–3 billion this year.
Right.
But I think when you combine this, we're looking at savings of at least $1–1.5 billion. So I think it's definitely going to accelerate streaming profitability for Disney.
Synergy to me means rebundling. So you're going to have to pay some big, heftier price to get all these different channels or streamers into one again.
Yeah, that's what Paul Sweeney would say as well. What I'm fascinated by is when we're all said and done with this, I mean, there's Hulu and there's Disney Plus, and they're going to merge and they're going to take on Netflix. Geetha, do you see a true duopoly out there? Is that where streaming is heading?
It definitely is heading there, Tom. There's no doubt about it. I mean, Netflix is far ahead of the competition. They have almost 250 million subscribers. We do see them getting to 300 million over, maybe the next few years. But yes, this is kind of very much turning into, Netflix versus Disney versus most probably Amazon. So yeah, maybe a duopoly,
what about
a
HBO
triopoly.
Max?
HBO, that's a tough one. HBO Max is probably
brutal. She's just
probably going to be a
nails.
second-tier service.
Second tier.
Look at her. She's just like
wow.
What's so bad about that, and this goes with Discovery Plus and Max and all that, is where am I going to see 90 Day Fiance?
I know you're addicted to it.
If it doesn't work out. Geetha Raghunathan, thank you so much. I think I learned something there. Pierre Ferragu wrote the black books for Bernstein on technology for years. Yes, he's got a fancy title, Global Technology Infrastructure at New Street, but the answer is once and forever, he will always own the black books over at Alliance Bernstein. Pierre, thank you so much for joining us. And you have been cautious on Apple. Is now a time to buy the shares after the lassitude that we've seen over the last 12 months?
I would have liked to say yes, Tom, but unfortunately, and the reason why I would have liked to say yes is because sentiment is very, very low on the name. 60% buy ratings and 40% sell and neutral rating for that name. It's very, very, it's as low as can be, I would say. So we've had like a very slow year, 3 quarters in a row. In negative growth. We're getting back to positive growth probably on the guide, but it's just because we're hitting like the easier compare now. And so that slowdown, like the stock reacted relatively well to that slowdown. If you look at Apple stock, it roughly tracked the Nasdaq. So not much happened on the stock. And the reason why I wouldn't jump on board now is first, not a significant pullback. So valuation, you're still paying like a hefty premium for Apple. Right. It's partly justified, of course, for the quality of the franchise. But what happens next that really creates a surprise and gets the stock to work from here? It's kind of an empty list.
The heart of the matter, Pierre, is single-digit revenue growth. So I went back to the pandemic, and basically sales are up 47% from 2019. Yes. But the free cash flow generation off that is up 71%. In your caution, are you suggesting that formula they have of operating leverage, of generating EBITDA, of generating free cash flow is now broken given single-digit revenue growth?
No, I think it still works, but of 5% revenue growth, you don't generate as much free cash flow growth. So the way I like to think about it is out of between 3 and 5% revenue growth, Apple can generate, above 5%, like 6-7% earnings, dividend, free cash flow growth on a sustainable basis through like systematic buyback, through operating leverage, etc. So there is definitely a huge amount of quality there and a very strong balance sheet, as you just mentioned. So all that is worth a premium. When you look at Apple today, it's trading on 27 times, forward earnings. Standard & Poor's names who grow between 5 and 10% per annum, their overall economics are trading on like 22 times. So you have a significant premium. So you won't have like a valuation surprise out of this very healthy, very high quality model. And so, when you own the stock today, you have to believe this premium is going to remain, which I think is fine. Mm-hmm. But you can't expect like a sudden jump and a sudden increase in valuation multiple unless you have a new growth story, and that's where it's kind of difficult to expect that to come
right.
through.
The China part of the equation is not a growth story for Apple right now. Huawei's Mate 60 Pro getting a lot of attention, kind of stealing the thunder in many ways. And Apple bears will always point to the China demand for iPhone 15 as a reason to not be optimistic. How does Tim Cook frame the negative headlines that are hitting Apple out of China, whether it's the Mate 60 Pro or whether it's Beijing's ban of using foreign phones for government workers or at state-owned enterprises?
Yeah, so I think it's a very good question. It's a source of concern. Interestingly, I don't think it's going to materialize that quickly because like the new Huawei phone is really like in early innings. They probably don't have a strong case to be that competitive against the iPhone. But it's true that, in this jump you mentioned since 2020, Tom, a lot of that was like Huawei getting out of the picture in China, and Apple really like gaining about 20 million extra units, iPhone units, combined with an increase in ASP. And so that part of the business, I think is true, is kind of at risk over the next couple of years. Because China might be able to pull together an alternative to the iPhone. The iPhone remains like an exceptional product. This is the only phone at a 3 nanometer manufacturing node for the main chip. Exceptional quality, exceptional like integrated software and hardware, etc. So I wouldn't say the Chinese are going to put out a phone that can compete with the iPhone, but we know that in the past about 20 million phones were selling at Huawei. And when Huawei disappeared, that market seemed to have moved straight into Apple's hands.
I see.
And that's a concern, of course.
So how about Apple and AI? I mean, Apple was kind of left behind when ChatGPT and all the other AI tools, took over the zeitgeist. I know Apple's working on things with relative to Siri and how it can incorporate more generative AI into its products. Is this something that has reached a point where investors can model it?
No, so I think on the business model of Apple, who is making all its profits from selling hardware and then selling like mostly subscription services over this hardware, the kind of like magical one trick where you can charge like $30 a month for a generative AI based service, that doesn't really exist. The way I see it is that for Apple, generative AI is going to be more of a defensive move. Siri has never been exceptionally impressive in terms of what it can achieve in terms of voice recognition and user right. service. Apple is going to continue to do their best to enhance the overall user experience with generative AI. But I don't see that as a revenue enhancement for them as it could be for like a Microsoft or Google and Meta on advertising and things like that.
Pierre, do you just to finish here, is Apple such a dynamo, like you were mugged by your kids to go in and buy more toys, like Brammo, like Fu, like Keen? I mean, we're all in the same game. Are you suggesting that this is a stock that treads water for 5 years, or are you actually looking for a diminished share price?
So that's, I think, from here over the next 5 years, I think that's a stock that can compound with its earnings power or its dividend power. So, it can compound like in single digits, maybe high single digits. So it's not too bad for a very high quality name. And then I would look at buying it only if there is a bit of a dislocation at some point, like a loss in confidence, if right. This quality perceived at Apple wasn't there all the time. And so if you see like a weakness coming out of China or things like that, and if the stock is hurt by that, I think I would be very keen to revisit and look at getting into the name at a more attractive valuation, because when you're talking compounding, then valuation is almost everything, because that's what drives your ability to buy back your stock more right. efficiently and things like that. Right. So I really think you need a lower multiple to make Apple a compelling single digit compounding opportunity. and then a kind of like a breakthrough opportunity, an opportunity to increase prices, to increase significantly volume, to launch a new product. Difficult to see that on the horizon, to be honest.
Pierre, thank you for the brief. Pierre Ferragu, for some real Apple caution there, different than the fanboys that so many people speak of. Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.